A debt could once be carried as a piece of wood. It had no portrait, no precious metal, and little value beyond the obligation cut into it. Yet when the stick was divided, one half could prove that payment had been made, while the other preserved the claim that still had to be recognized. The wood did not settle the transaction, it kept the transaction open. That was its power, and also its limit. Before coins, before banks, belief ruled the world. Notched sticks had been used for counting long before medieval governments adopted them. Marks could record animals, labor, deliveries, or quantities owed. But when a stick was split lengthwise, the same cuts passed through both halves, producing two records from one act. In the English Exchequer, officials cut notches for the amount, then divided the stick into matching pieces. When the halves were brought together again, the grain, shape, and cuts had to align. A mark added later would appear on only one side. The record carried its own test of authenticity. This was not money in the ordinary sense. The wood was not valuable because others wanted wood. It mattered because an authority or another party was expected to recognize the obligation attached to it. The tally contained evidence, not wealth. That made the system useful when payment and accounting occurred at different times. A sheriff might deliver revenue to the exchequer and receive a tally showing the amount paid. Later, when his accounts were examined, his half could be matched against the government's record. The payment had occurred, but its acceptance was not complete until the audit confirmed it. Time did not erase the obligation. It preserved the need for proof. The system reduced dependence on memory, but not on institutions. Both halves had to survive. Officials had to cut them correctly. Archives had to preserve them. A tally could verify a claim only inside a structure capable of recognizing it. Within that structure, wood could support more than a receipt. Royal finance also used tallies to assign future revenue. The Crown could acknowledge that money was owed and direct payment from taxes expected later. A creditor holding the tally possessed a claim against revenue that had not yet arrived. Present expenditure could therefore be connected to future collection. At that point, the exchange became more abstract. Coins might not move when the obligation was created. What moved was the right to receive coins later. The tally allowed value to cross time before the underlying revenue entered the treasury. This helped government operate when immediate cash was insufficient. Suppliers and lenders could be promised payment against anticipated receipts. Some tallies could pass to other holders when the claim behind them was trusted. But acceptance was never automatic. A recipient had to believe the revenue would be collected and the authority would honor the claim. Credit had become portable, but only within a circle of recognition. The human consequence was clear. A supplier who accepted a tally had delivered something in the present, while payment remained in the future. His labor, goods, or silver had already left his control. The Crown's obligation remained, but the waiting belonged to him. If revenue arrived late, or officials disputed the record, the wooden claim did not restore what had already been surrendered. The tally therefore separated acknowledgement from settlement. It could prove that something was owed without determining when usable payment would appear. The obligation became clearer. The timing became less certain. Its reliability depended on the authority behind it. Two matching pieces could show that a record had not been altered, but they could not force a weak debtor to pay. Physical security was not financial certainty. The wood protected the terms of the claim. It did not create the resources required to satisfy it. Scale tightened the problem. In a local exchange, the parties might know the circumstances behind the marks. In a royal system, thousands of obligations had to be cut, stored, retrieved, compared, and linked to written accounts. As the network grew, the tally depended more on clerks, archives, standard practices, and continuous administration. A device that reduced one burden created another. Tallies also remained tied to specific obligations. Coins of the same denomination could often be treated alike. Tallies were not necessarily interchangeable. Their usefulness depended on who issued them, what revenue stood behind them, whether they could be transferred, and when payment might be obtained. Similar pieces of wood could carry different levels of trust. For centuries, the English exchequer used tallies alongside parchment, coin, and later paper instruments. Their survival did not prove that wood was superior to writing. It showed that an old technology could remain when it still performed a narrow function reliably. The tally was cheap, resistant to simple alteration, and embedded in procedure. Yet as finance expanded, the procedure required to preserve and verify it increasingly slowed the movement of claims. Written receipts, audited accounts, transferable paper instruments, and banking institutions could carry more information across wider distances. Wood could confirm a cut. It could not easily express changing terms, partial transfers, accumulated interest, or complex chains of ownership without additional records. The tally had transformed memory into an object and obligation into a matching surface. It showed that credit did not require metal, but it did require recognition, administration, and time. Once claims moved beyond the people and offices that understood them, the material record became too narrow for the system it had helped create. The wooden stick had not replaced money. It revealed something more fundamental. Value could rest on a promise, provided the promise could be verified and the authority behind it remained credible. Yet even a perfectly recorded promise could not adjust when the supply of the goods behind payment suddenly changed. In the next episode, we will examine how grain shortages created early price instability. As supply contracted, fixed obligations, even when verified by tally, remained exposed to the changing value of the goods required to fulfill them.